Keith. How are you doing? We're happy to have you back.
Thanks. I appreciate you having me.
Of course, of course. So I know the audience is ready, so we'll kick this right off. So to set the stage, can you break down the differences between both traditional and Roth retirement accounts? And I know you like to say, do people rather pay tax on the seed or the harvest? Can you break down that analogy as well?
Sure, real simply, and we'll get into the more advanced tax strategies as things go, but breaking down the basics, traditional, you get a deduction when the money goes in, and you have to pay taxes when the money comes out many years later. With the Roth, it's the opposite. There's no deduction when the money goes in, and there's no tax consequences when the money comes out. So if we're laying seed out there, usually we're going to you can either pay taxes on the seed, um, and you get the deduction going into the traditional, but then you're also paying taxes at the harvest, or you can make the whole thing where there's no deduction when you're putting it in, and there's no deduction when it grows and becomes hopefully something much larger through a Roth.
Amazing, amazing. I love that analogy. That just paints a super clear picture. And very appropriate with the plant, money trees, people looking to have it grow.
Yep.
All right. So people tend to wonder, should I use a traditional? Should I use a Roth account? Do you have any general rules of thumb, maybe a person's age or a tax bracket that might help them make that decision?
Yeah, so usually under age 40, I'm going to suggest Roth because you've got many more years for it to grow. Um, Age 40, it's debatable. There's a strategy I'll share at the end of the webinar that makes sense no matter what age you are. And then age 50 is typically you don't want to do Roth because you don't have as much time to make back the difference if you're um, because you have to pay taxes along the way. So usually there's a haircut in your 50s, you're at higher tax brackets. And so going Roth, you've got less time to make up for the saved taxes if you had done a Roth. So with the Roth, there's no deduction against your earned income. The other factor that you alluded to is when somebody's at a higher tax bracket, a traditional retirement account makes a bigger difference. So if you're young and you're sitting at a 15% tax bracket, that's a no-brainer on to do Roth anyways. But if you're at a 37% tax bracket, maybe it makes sense, especially if you don't think you're going to be a good investor and it's not going to grow very much. But as a whole, I know that's clear as mud. Generally, under age 40, I'm going to do Roth. Over age 50, I'm going to do more traditional.
Right, right. So, in terms of moving into the 401k versus IRA debate, so most people assume that IRAs and 401ks serve very similar retirement savings options, but there are differences between the two, as you know. From your perspective, what are some of the key distinctions that people should understand comparing both accounts, and even in particular, solo 401k in the mix?
Yeah, this is a big one. A lot of people think that they're nearly interchangeable. So to be clear, an IRA is an individual retirement account versus a 401k is an a sponsored retirement account. And so in a solo 401k, you are both the business owner and the plan recipient. And so if I had to choose the two, I'd always go 401k, assuming you've got a business as part of that. The reason is, so let's say you may had $1 million in IRA account, and let's say you did a $100,000 investment that the IRS later determines was a prohibited transaction. The IRS is going to blow up the entire IRA, and so you're going to lose by the time things are done, maybe 90%, $900,000 of your balance to penalties, fees, and interest in the IRA, of the entire IRA. Let's say you did that same transaction in a 401k. In a 401k, there's a 15% penalty times the $100,000 investment you made. So now the penalty is like $15,000. So blowing up your entire IRA, losing $900,000 versus making a mistake in a 401k, losing $15,000, very different. Also, if you're ever investing in something with debt financing. So typically, if you invest in a retirement account in anything like a traditional stocks, bonds, things that are publicly traded, there's no tax consequences. However, there's certain circumstances where if you invest in like commercial real estate, residential real estate, and there's any sort of loan associated with that, that's when you can be forced to pay taxes. So let's say you bought into an apartment complex and into a syndication, you invested $100,000 and there's an 80% mortgage to purchase that property, then 80% of your net income becomes subject to taxation. IRAs have to pay that unrelated business income tax, the taxation associated with that financing. 401ks do not. So if you want to do any sort of like real estate syndications where there's debt financing, which is most real estate syndications, a 401k is nearly always superior. Additionally, you can do like a $50,000 loan if you want to take stuff out. And with an IRA, you can access it once you're 59 and a half. Age 55 in a 401k, there's a little bit of a loophole. Sometimes there's two spouses working together, and whoever the older one is, which quite often ends up being the husband, can get fired by his wife. And if you get fired age 55 plus, you can actually access your 401k early. And so that's kind of another loophole to get access to your funds. So there's just more flexibility, more benefits with the 401k over an IRA.
Yeah, no, some interesting flexibility there. I didn't know about the that rule that you mentioned with the husband and wife and firing situation. I'd never heard of that before.
So that's the loophole. So typically it's you're working for another company, you get fired, now you can tap your 401k early. And so
Right.
sometimes if we got the two working together, one's the boss, the other one gets fired, it's another little loophole for you.
Yeah, yeah. No, very, very interesting. And who might be eligible to establish a solo 401k? What's the criteria?
Anybody who's got an active trader business. So it's got to be income subject to self-employment tax. If you've got that, even if it's just $1, $1,000 worth of profit, it needs to be a legitimate business. There's no minimum requirement on income, but you should have some income associated with it. And the moment you have that, you can roll over existing 401k plans or traditional IRA accounts into your 401k.
Right. And this is a little bit of a question, kind of tangent, kind of related, but what's the qualifications for people to establish an IRA? I know sometimes we get that question coming in the self-directed space.
Man, so first you got to know somebody you like and trust, like Madison Trust.
Oh,
No, that's good. No, to have an IRA, you've got to have just a minimum level of earned income as well. So all sources have to come from earned income. I believe that's around $7,500 right
Mhm.
now is the max you can put in as an individual. But a 401k, you can actually put in a lot more, which is another bonus point for 401ks.
Amazing. No, thank you. Thank you. All right. So, to the Mega Roth strategy. Excited to talk about this one. So, most people think retirement contributions are capped at a few $1,000s, kind of what we were talking about before with
Yeah.
IRAs. Could you explain how the Mega Roth 401k strategy generally works and how an individual could potentially contribute up to 70,000 or 77,500 if they're 50 or over in a single year?
Yeah. So there's a few different buckets that we're looking at to fill a 401k. And so in total, we can put a max in of 77,500, which you said. And that breaks down into a few categories. So one, as an employee, you can put up to 23,500 as an employee of your own business. If you're over age 50, you can do a catch-up contribution, which is $7,500. And then the employer can contribute up to 25% of your compensation for a total of 46,500. And so and which is how you get to 70,000.
Wow, that's what, 10 times that of an IRA? That's just
Correct.
about,
It
yeah.
is super substantial. And so I'll actually run the math for some of entrepreneurs. They're not necessarily trying to pay themselves $200,000 almost to max out the full. If you can only pay yourself 25% of that as an employer, um, you're somewhere around 190, 191,000, you're hitting that limit, but that's a lot of self-employment tax. And so
Right.
often we'll run the math and it's usually somewhere around $40,000 as a salary. Almost all of that can go towards your 401k contributions between the employee and employer side. And that's just a great write-off. And as a lot of small business owners have to pay themselves some sort of compensation if they've got an S corp. And this is a way to avoid paying taxes on a big part of that by putting it into a retirement account.
Right, right. Amazing. So now transitioning into one of my favorite topics, self-direction. So what does it mean to self-direct a retirement account exactly, and what type of investments are allowable in self-directed accounts?
Man, so the Wall Street would have you believe that you can only invest in their products, the the typical stocks, bonds, mutual funds that they all get to earn a big fee on. I like self-direction because it allows you to really go into almost anything you want to be in. So we have to avoid certain things like collectibles, but there's a way to do just about any sort of precious metals. Typically, you can't hold, like if you want to do precious metals, you can't hold it yourself, but there are third parties that can provide custodial services for that. And so with that said, if you want to invest in somebody else's business, real estate, stocks, equity deal, just about anything you can imagine that's a legitimate business, you can invest in it. And so I get to work a lot with family offices and I have a community of investors. And so what we look at are how are the billionaire families making a lot of money? And the stats show about 55% of their portfolios are in alternative assets, things that they can
Wow.
self-direct, and the other 45% are in more traditional liquid assets like stocks and bonds. So there's definitely still a place for that so that you've got some liquidity associated with that. But they find that most of the return comes from the alts, which is why I love referring people to you guys because you guys help facilitate that, allow people to invest in some of the other great deals they're seeing.
Yeah, no, thank you. Thank you. We appreciate that. And even some of, to go off your point, Keith, some of the crazier things we've seen are Arabian racehorses, livestock, I mean, Broadway production. So, I mean, really to Keith's point, pretty much you name it. Obviously, like you said, there's some things that are off limits, but pretty much you name it, there's a likelihood that you can invest in it with a self-directed IRA, which I don't know. I really love what we do. It's very cool. Amazing. So you've discussed a strategy commonly referred to as the discounted rollover. Can you explain how
Yep.
someone might move an investment from a traditional account to a Roth account at a lower taxable value?
Yeah. So this strategy works whenever we have a predictable drop in an asset value. So how do we have a predictable asset drop in asset value? Well, if you're an amazing stock person and you know Google stock is going to drop from making up numbers from $1,000 to a share down to $500 a share, you should absolutely be timing the market. And I hope you're a billionaire as a result. For the rest of us, I don't have that kind of a glass ball, fortune, crystal ball. And so we find scenarios where there is a predictable drop in value, and we use it to time rollovers from a traditional to a Roth account. So let me give an example. Let's say you're investing $100,000 into a hotel to apartment conversion. Day one, you invest $100,000 with a third party syndicator. Day two, that syndicator is shutting down that hotel. What is a shutdown hotel worth? A whole lot less than you paid for it. Risk is higher, uncertainty is higher, you've got the renovation ahead. And so we go in and we do a third party appraisal. And if you're familiar with estate planning discounts, we can stack on lack of marketability, lack of control. And now we're getting another 20 to 40% off that discount. So all in all, on a hotel discounted rollover deal, we're often looking at a 50 to 60% discount, sometimes more. So your $100,000 temporarily is worth $50,000 by an appraiser, and we do a rollover of the $50,000 asset, not the cash. We pay taxes on the $50,000. There's a 1099-R, all the reporting. And then years later, when the hotel reopens as an apartment complex, which benefits from an increase in value, different metrics on NOI, now maybe we have $200,000 all within a Roth and it's never taxed again. So backing up from your side, you got $100,000 deduction for putting the
Wow.
money into a traditional account. You had to pay $50,000 to roll it over, but you're still ahead in that by $50,000. And now you have $200,000 in a Roth and it's never taxed again.
Wow. Amazing, amazing. And so, in terms of listeners that are interested in learning more about these concepts, maybe other potential tax strategies, how can they connect with you or access your tax strategy implementation guide?
Sure. Actually, I've got a link I'm happy to share with the audience and listeners, but you're welcome to email me, Keith@financialjourney.life. Happy to connect with any of your listeners, and I'll make sure that we're able to share that slide. I've got a QR code if that makes sense for people. Um, yeah, here, I'll flash that on there for just a second in case anybody wants to get a hold of me. And would love to connect with people if they have questions about this or they're interested in what it means to be part of our investor community.
Amazing, amazing. Yeah, so there's Keith's email, scan the QR code. And now, actually, I'd like to turn over the floor to you. I know you had some slides you wanted to share and just any general tax advice that you wanted to share as well.
Man, there's a few things. One of the things that we also like to do is we'll aggregate different accounts together. And so sometimes you've got your HSA, you've got your IRA, you've got your 401k, your spouse has their HSA, IRA, 401k. Sometimes we try to roll things together, but trying to have all these small accounts for $20,000 here, $40,000 there. It's great that you've got these accounts, but trying to manage them all efficiently is really tough. And so we will form an investment partnership that's just you and your spouse, maybe your kids, and it allows you to aggregate everything into a single entity that now you can invest. So if your wife has $100,000, maybe you have $200,000 in there, maybe your kids have $50,000 each if you've got two kids. In total, now that's $400,000. That allows you to actually go do a significant investment where often the investment minimum is $50,000 or $100,000 or more for the alternative investments that really provide a higher rate of return. This is a vehicle that allows you to manage your money. Now, you also have a single entity that you can go do brokerage accounts with instead of trying to manage stocks and bonds, like having worked with families that we're trying to manage a lot of different accounts for a lot of people. There's inefficiencies there. And so we can do a lot, but it can be easily, you get multiple family members, you can have 30 to 60 accounts at some point where this just keeps growing and growing. And so having a single place for all your retirement accounts allows for more efficient management, for tracking, and allows you to get better deal economics as you're looking at different investments.
Amazing, amazing. All right.
So
With that, I'm happy to open up the floor to any questions that any of you guys have. If you want to put them in the Q&A chat. And for now, I see there's some rolling in. So one question that came in is, what are some of the common retirement planning mistakes you see investors make when they're evaluating a long-term tax strategy?
one of the biggest ones is not thinking about, is this a good fit for my retirement account versus me personally? So if something's going to generate ordinary income like interest income, typically that's going to flow when it flows through to your personal name, that's going to be ordinary tax brackets. And I would rather put that in my retirement accounts. If, however, I could do, let's say I'm getting something that creates big tax deductions, like maybe certain real estate investments or oil and gas, I'm more likely to do that in my personal name. But if something's a great investment overall, like you really think you've got something that's going to go to the moon, it's the next great big venture capital deal, I'm more likely to try and put that in my Roth account so that I'm not paying taxes on that. And so there's a lot of strategies out there. And so just understanding if you've got a significant retirement balance, you should put a significant bit of effort into understanding different retirement account strategies. Often investors get so caught up in their day-to-day career, their day-to-day business, that there's a transition they miss from where they're working in the business, working in their career to really managing their wealth like a business. If you have $1,000 and you can earn an amazing 20 or 30% return, that's 200 or 300 bucks. Like you'd be better off growing your net worth. If you have $1 million net worth and you can earn an amazing 20 or 30% return, not saying that's what we should be doing, but if you can do a really high return, put a bit more effort into your wealth business. And here, if you have significant retirement accounts, that should be a significant part of where your effort is understanding the rules, the strategies. How do I grow that? And because so much of it is already in a tax-free or tax-deferred account, really think about how you can grow that and what are some of the strategies that allow you to maximize that growth and optimize for future withdrawals.
Right, right. Amazing. So we had another question come in. I'm a real estate broker and actively participating in a long-term and short-term rental and an investor as an LP in real estate syndications and real estate funds that hold multiple types of real estate. I receive passive income. Can I establish a solo 401k?
So as a real estate broker, I'm assuming you own the business. If you have employees, you can't establish a solo 401k if you have 50% or more ownership. There are ways to maybe establish a full 401k for some alt investing, but there's not many that do that. And so I would suggest if you're just a solo broker, that would absolutely work. And I would be trying to, hopefully you're making good money. And so I would dump the full 77,500 in there to maximize your retirement accounts.
Amazing. And how do you think individuals should think about balancing both liquidity and also their long-term retirement savings goals when it comes to investing in general?
Man, so I hit work optional. I had some early success doing commercial real estate, growing a CPA firm, and had an exit 2016, 2017. Not here to brag. Uh, age 32, like I had hit work optional, I was good. And then I
Right.
started doing this because this is fun. And so initially, I didn't want my mentality was I don't want the government telling me when I was going to retirement. So I disregarded all retirement account investing. I just hit 41 and now I'm looking at, you know what, 20 years from now, retirement, maybe 30 years from now, that doesn't seem so far away from now. And so now that I had enough of a personal portfolio growing where I said, hey, this is enough, I can live off that if nothing else changes, then I really shifted to growing more of my personal portfolio. So we also have some guidelines on how we manage investment portfolios. So one, I would want at least 30% of your portfolio to be liquid. So I wouldn't want more than 70% of your net worth to be locked up in retirement accounts. And some of it's also as you approach 60, it's less of a concern because you can touch it. In your early years, if you're age 20, 30, you're going to want to be able to tap that. The closer you get to that, the less concerned I am about having stuff locked up in retirement accounts. And so maybe that liquidity swings from being 30% of your stuff max in personal stuff younger to maybe a 70% number or something a little different later.
Right. Amazing. So another question came in. Keith, do you have your website or anything I can learn more about you or any service that you provide, tax or investment advisor?
Sure. Financialjourney.life. I think I can put that in the chat or somebody can help me out there.
Amazing. All right. So another question came in. Is it possible to devalue an investment asset like real estate or loans in a traditional IRA, then roll over to a Roth IRA?
Yes. Yes. Great question.
All right.
We can absolutely do that. So there's some attorneys that will do that. If you email me, I'm happy to just pass you over to a couple of options that absolutely do that. That's something that we will do if it's like a large syndication. We'll partner with the syndicators. We intentionally don't make money based on how people invest. That's not how we work. We've got more of a community approach, community due diligence council. But for the stuff that does pass, we absolutely want to walk alongside our investors, our community to help them do the rollover, because getting a few of these discounted rollovers in place and moving your money from a traditional to a Roth account can have a super meaningful effect on your wealth growth and avoiding future taxation. And as much as I'm sure we all love the government, I don't want to have to give them more than I have to.
First of all, I love the enthusiasm when you got that question. That was amazing, unparalleled. And second point, I did want to make note to our attendees here that we were able to drop Keith's website in the chat. So guys, feel free to save it, click on it, bookmark it, and you'll be able to get his information and more there. To continue on to the next question. So I have a TSP IRA. How can I do an SDIRA with each of those? Or I guess having both of those open at the same time.
So I know a self-directed IRA. I know an IRA. I'm
I think
sorry,
TSP is a
TSP.
thrift savings plan, if I'm not mistaken.
Man, I don't think I've had. Okay, so I know you can absolutely do self-directed with IRAs. You can talk to Brianna about setting up one of those. Do you guys serve TSPs?
Uh, we do not, but if someone, let's say, had a TSP, we do accept rollovers into the self-directed IRA. So if they
Okay,
were looking to roll
okay.
over, maybe a portion of that, they could roll over a portion of that, as long as it's good with their current plan administrator, which we always encourage them to check with first.
And you guys also do HSAs?
We do not know.
Okay, someday.
Someday, it could be on the list. Amazing. So another question came in. What do you think about annuities?
Man, I have been on both sides of the pendulum with annuities. So annuities can have high fees, and it really depends. Typically, the typical annuity that a financial advisor is trying to sell you, and let's back up. A financial advisor in most cases is only compensated based on the financial products that they're to sell you. They try to set themselves up as an independent third party, but just look at the comp structure. If they're only getting paid when you anyways, so annuities typically have lots of high fees. And so for the longest time, I was anti-annuities. I've also seen where somebody's like, hey, I'm late in life. I don't have the brain power to manage my financials. I just need to know that I have a monthly check coming in. I think there can be an argument for them. There's a simplicity to I just write somebody a check and I get money back, somewhat similar to a reverse mortgage, but people might debate the ethics of that. On the flip side, if you're under 75 and you've got a little bit of energy to really manage your wealth like a business, you can do way better and outperform annuities. There's a ton of vetted providers and folks in our network that we've got a long track record with that do way better, and you can go direct to them, and they'll do typically much better than an annuity. In a retirement account, there's an appeal to passive cash flow, just ongoing cash flow that's coming in on a regular basis. And annuities help solve that, but they take a big fee for that. And so you give up a lot of the upside.
Right, right. Amazing. So another question that came in. I hold a real estate broker license in Massachusetts and just moved to Charleston, South Carolina. Oh, so no, I do not own a firm, but expect to be involved in real estate here as an agent. Oh, that's clarifying that other question
Yeah.
about the original real estate broker.
So here's a clarifying answer. If you are paid W-2, you can't do a solo 401k, at least through that activity. If you start a separate business, that's different. If you are paid via 1099, then you can. There's some specific regulations about real estate agents that vary state by state. I'm in the Dallas, Texas area, so real familiar with those are here. I don't know every state. And so some states don't want you to run your license through any sort of an independent entity or third party. But I'd be 80, 90% certain there'd be a way to set that up just fine as long as you're 1099.
Amazing, amazing. So another question that came in is, what are some popular alternative investments that you've seen, your clients invest in? Maybe not specifics,
Popular.
but
Yeah.
like asset
Yeah.
classes, I'll say.
Sure. So we'll go with a few. If you're a high income earner, working interest in oil and gas. Forgive me if you don't like oil and gas as for pumping out fossil fuels, but it creates, from a tax perspective, large working interest. You get an 80 to 95% deduction in the year you did them when you invest. Plus, you get another typically 3 to 5 years of strong returns. Our stuff is normally in that 20 to 30% internal rate of return range. You got to be careful. There's a ton of scammers out there. We've got the chief drill officer of a publicly traded company in our community, and then we'll hire two outside oil and gas analysts that will go in and vet everything in depth. And that's how we feel comfortable about those. We've got some, real estate deals. I've had my share of things that haven't worked out, but we've got a handful of guys that are just killing it in the southeast right now that are more flipping apartments and delivering a somewhere between a 40 to 70% return each deal. Um, Results not typical. I try to be careful. Sometimes for more of our passive cash flow, sometimes we're looking at more of a royalties play, whether it's music royalties, oil and gas royalties, could be certain high income like debt fund where there's liquidity, and we monitor. We've got to stay on top of those as a due diligence council. There's a lot of things that we monitor, and then if anything ever gets risky, we tell people to pull out. So it's kind of like there's those that go into the stock market and they're going to be on their stocks every single day. They're going to pay attention. If you're that person, you should absolutely do your own thing and be a day trader. We found for a lot of other people, they're busy with life. They want to focus on their career, their business. And so having a group of people that you can trust that is paying attention and helps you know, hey, I need to get out of this or this isn't going right. And then as a community, we can come together and work together to get a good resolution. We haven't had any of our investments go to zero yet. It may happen at some point, but it's really that approach of doing the due diligence up front, because that's typically the only time you get to influence the outcome of the investment as a passive investor. Do I invest or don't I invest? And then managing situations. If there's anything that starts to go off course, you want a team of people that can intervene. And we haven't had to involve lawyers, but we've had them in. We know of good people that have been involved when we need, and that's made all the difference. So for the most part, we've run a super clean ship, super clean portfolio, and a lot of that has been because we're paying attention and everybody gets to invest in whatever they choose. We're not managing their stuff. So that's why it's by design. And retirement accounts have been just a huge part of that, as people have felt confident putting some of those sacred dollars into things that they've felt confident in.
That's amazing. Amazing the way that that's set up and structured and how you really work together with, the investors or the families too that you work with. Amazing. So one question that came in is, I'm pretty new to retirement planning. What are the most important factors to evaluate before I open or contribute to an account?
To retirement planning, I'd start with any planning is what's your goal? And so if we know the goal, like you want $10,000 a month next year or age 65 or whatever that might be, then we can reverse engineer the wealth and taxes to get there. So as a CPA, um, I'll run the numbers on the front end. We'll look at what the portfolio, what's achievable. If you don't like the current results, what are the options to do more? Or maybe you already have enough, we can coast. I love reviewing your draft tax returns as a tax strategist to help provide those results. But it's really that comprehensive approach of starting where your goal is and then understanding where you're at. It's not a one size fits all strategy. Each person, each family is different. And a lot of people take that approach of we're just going to put your stuff into a calculator. And there's factors that go beyond the numbers, including your kids. Like so often people get focused on what assets am I going to pass on? And for me, I'd rather start with like, what are the values you're trying to pass on? And really think about the relationship side, not just about the numbers. And so, not trying to give a cop-out answer here, but it really starts with a goal. And the goal isn't just the numbers, but it's also all the other stuff that goes into wealth. Because if we're looking at transitioning wealth, it's not typically the hard science stuff like the wealth and taxes that make things go well off. 85% of family offices fail because this is something related to relationships, lack of preparedness, lack of purpose, those kinds of things.
Right. No, it makes sense. That totally makes sense. And we always like to say here, begin with the end in mind, right? What's the goal? What are you looking to achieve? And then from there, you could plan. So I'm totally in line with that. Amazing. So another question that came in was, can you please suggest several other alternatives to annuities?
Man, so that's working interest, oil and gas, royalties, could be oil and gas, could be lending, could be a hard money lending fund. You really got to pay close attention. I'm aware of Blue Owl and some of the other commercial real estate loans. So you got to really look at liquidity and some of those facts. Sometimes it can be a good stock strategy, could be dividend paying stocks, but all of those introduce a certain level of uncertainty. There's strategies with infinite banking. There's all those things out there. And so backing up, if your goal is certainty and you want to feel confident this is coming in every month, you can do the annuity and you're going to give up some of the upside, but you're going to get more certainty beyond that. For me, managing a range of alternative investments isn't stressful for me. It's something I do every day and I feel confident in. But if you're just getting started and this feels scary and you're in your latter days and you just want something that feels certain, then maybe a reverse mortgage or an annuity or something like that is the right answer. Just know you're going to pay an extra fee for doing that, and it's somewhat significant. But maybe you're okay with that. There's a trade-off. There is not necessarily a bad answer. I don't think all annuities are bad. I just, for the level of, for a little bit of effort on my part, I know I can get much better results.
Amazing. All right. So another question came in. I have both a 401k and an IRA at this time. What percentage of my retirement should change to a self-directed IRA?
So I think my question there is, if you can do a solo 401k, I would roll probably everything into the solo 401k. But if you're with an existing employer, most employers, while you have active funds, don't allow you to roll funds out to anything self-directed. And so, to be clear, typically most IRAs, most 401ks, you're with a 401k, you're with a custodian, typically that your employer chooses. And now you've got a handful of what, 10, 20 options. There's just a handful of different stock options. There's a target date fund. That might be the right answer. Probably for a lot of people, simple is best. And for simple, leave it alone. You're going to get average results. And that's maybe fine for a lot of people. For those willing to do a little bit more, there's a reason why most in our community, 85% plus, are earning 15% plus in their portfolio. And so it requires just a little bit of effort. And so if I were to choose, like, what am I willing to self-direct? I'd probably self-direct all of it. Now, what does it mean to self-direct? Self-direct doesn't always mean alternatives, but it provides that option. I would probably do just general advice without seeing your stuff dangerous. So obviously go consult your own tax professional. As a whole, look into how family offices do it. They're about 55% alternative assets. And about 45% stocks and other traditional assets with liquidity. We've got in our portfolio guidelines we issue to our community, we suggest at least 30% liquidity through publicly traded assets or assets that you could liquidate within a day or week, something like that. Different members have different rules, but the point is you've got significant liquidity, so you're never stressed out about being asset rich, like having a ton of alternative assets, and being poor with liquidity. There was a time, especially my exit, we went and traveled the world for 3, 4 years, and had a blast doing it. We were young then. I, as a CPA who knew the best performing real estate syndicators were, and so I gave them a large chunk of money, and that went really well. But there was a point where I was like, oh wow, I've got all these assets, but the cash flow wasn't keeping up with some of the other things I wanted to do, and I realized it was more cash flow poor. And so I had to shift to really prioritizing more cash flow investments and more liquidity. And so that was an important thing to keep in mind. So that was a very long-winded answer to what was a simple question. Thank you for listening.
No, it was a wonderful answer. Very, very comprehensive. And just to throw in here, if anyone is interested in a solo 401k, our sister company, Broad Financial, does offer them. So you could always reach out to us if you're interested in setting up that type of plan, or even just to learn more. Amazing. So in terms of another question, how do you feel about starting a self-directed IRA and borrowing within it to yield more bang for the buck?
Um, so one, typically when you're borrowing from your IRA, it's just pulling assets from yourself. So I'm not sure that would increase the bang for your buck if we're speaking like pulling money from like an infant banking policy or a home insurance policy. Depends on your risk flavor. I've got people in the community that have the $1 million house and they routinely borrow $500,000 to go do these investments, and they're making way more money. They're really trying to optimize every cent. In my relationship, I have a wife and she is wonderful, and she doesn't like the idea of having any other debt on our house. And I've got others, we've got like a 2.5% 30-year mortgage. So I'm going to stay with that for a long time. On the flip side of that, I've got other people that want to be debt free on their home wherever possible. And so there's the point is, if we're talking strictly numbers, having more leverage is going to introduce more returns and the possibility of risk, and you've got to really watch that risk carefully. There's also an emotional aspect to this where sometimes people will say, hey, go talk to my wife. I want you to tell them that we don't need to be debt free. And that doesn't always work because hard math returns does not compute with the I want to feel safe in my home and know I can't lose it. So
Right.
it depends for each person. It's a different answer.
Amazing. And in terms of, if somebody's starting to save for retirement, similarly to a question that was asked earlier, what age would you typically recommend that somebody start with their retirement investing and savings?
As soon as possible. So we've got people in our community age 7, 8 that they find a legitimate way to put them on payroll.
Wow.
And the kids are learning how to invest it at a young age. Actually, I've got my boys are now 4 and 7. So this will be the year
Oh,
that I put the 7-year-old, he's going to have to do some work, but he's also going to start learning how to invest from a young age. And I'll just start by saying, hey, what are you into right now? And we just discovered Pokemon like 3 weeks ago. So that's a whole thing. But I was like, fine, let's invest into the Pokemon company and just see how it goes. And so for me, this is less about the maximizing the dollars and just having him have a positive experience of investing and learning how to do so from an early age. And so having those things from an early age is going to allow him to become a smarter investor later. And if he starts now and we consistently help him invest, max out his retirement accounts, we can give him the greatest gift of being financially free, guaranteed by age 60. He's got the power of compounding and has to work a whole lot less than the rest of us do at this point.
that's awesome. I mean, first of all, I'm very in line with him. I'm a huge Pokemon fan. It was one of my favorite shows as a
That's fun.
kid, and I used to trade all the cards. They're somewhere. Hopefully, I'll find them one
Yep.
day. But no, that's a very, very great message of, really the time to start is now, or as
Yep.
young as possible, even. And, even on our end, we do offer the option of custodial accounts where either the parent or guardian would be the one who's,
Yep.
of course, managing the decisions. But for example, we have some clients who they're on the younger side that maybe they're, 13 and they're contributing their babysitting money or something along those lines. So
Mhm.
it is possible to get kids in the investing game, even in the alternative space, pretty early. So just throwing that is an option, an account type that we offer out there. Amazing. Any thoughts on investing in crypto assets and what percentage And what percentage? Any way of safely doing this percentage of assets?
So I'm going to speak specifically. I know there's a ton of crypto assets out there. Going to speak specifically to Bitcoin. We can talk about Ripple or Ethereum or some of the other stuff, but some of it depends on your philosophy. So why own this asset? So Bitcoin, if traditionally is a store of value, there's only a limited amount out there. They're only going to make X amount of coins, and uh, there's not enough. If every millionaire wanted to have one Bitcoin, there will never be enough produced for every millionaire to have one. And adoption has gone up. We've seen Freddie Mac is now offering loans, crypto-backed, Bitcoin-backed loans with crypto. So that is just speaking to the wider institutional adoption. And so we're in the next quiet phase where people are quietly buying it up, and I think the institutions are buying up. So there's a long-term case for owning this asset. Um, and then it's like the purpose. Is it just for returns? If it's just for returns, I could see where there's a case for owning that in your retirement account. There's some custodial stuff that needs to be worked out. Um, but I see that case. For me, part of my Bitcoin is a plan B asset, meaning if something happens where I live and I need to jump on a plane and go someplace else, um, having that USB stick with my Bitcoin on it, or I'm not going to get technical. I've got my Bitcoin. That means I can go anywhere in the world and I've got my money. If I'm doing that with the retirement account, I can't have that same level of control. And so for me, it breaks the plan B part of it to do that in a retirement account, but I'd absolutely own a percentage of it in my personal wallet. I'm not, there's Bitcoin maximalists that have gone all in. I had a client 3 years ago that was doing really well from his crypto. And part of what we did was helping him transition part of his Bitcoin into other real physical assets. So we bought an island in the Caribbean and he started building on it. And so happy for him. He did really well with it. But that's just not me and my style of investing. So I have an allocation to it, but it's not all me. Um, and so some of it depends on your own personal convictions and you getting educated about it and deciding if this is one of the things you really want. I also like the fact that it has a measure of liquidity, meaning I think with Bitcoin, you can typically get liquidity like back to dollars within a week or so. Plus, there's other ways to spend Bitcoin these days without having to go to dollars.
Amazing, amazing. That island sounds very nice. All right. Another question came in. Are insurance products part of your funding retirement, or do you advise utilizing only for ST needs or age groups?
For short-term needs. So I will say I thought infinite banking for the longest time was a giant scam. And so here's the threshold of what I think is whether or not you have a scam. So I did a LinkedIn post on this probably 6 months ago, and it just completely blew up, tens of thousands of views with people expressing all sorts of very big opinions. And my approach to things is I try not to take a side, but I'm very much here are the pros, here are the cons, you decide. In my case, we personally are going with an indexed universal life policy. My wife and I put $100,000 a year away into each policy, and it can grow. And what we're able to do with that is you can choose different indexes. You can earn 9 to 12%, sometimes more, but 9 to 12% on that growth. We can then withdraw all the funds and go invest it in alt deals. So we're still, even if I put in, I'm just going to make up numbers. Let's say I put $1 million in and I can withdraw 90% of that. I've got $900,000 that I'm able to go invest. I'm having to pay interest on it at about 5.5%. But if I'm investing and earning 12 to 18%, I'm okay with that arbitrage. And then simultaneously, my initial $1 million balance is also growing at 9 to 12%. So 9 to 12% minus 5.5% interest rate, it works. One of the big keys is, are you in a high commission product? If you give somebody $100,000 and you can get 85 to 95% back immediately, then you've got a low commission product. If you put in $100,000, you can only get like $50,000 back immediately. Your salesman took a really high commission, and it is possibly a bad policy. And so I've seen policies from Northwest Mutual, I've seen Emeritus, I've seen other policies out there, and it largely depends. The agent can write different how much they want their commission to be. The guy I work with is like the third highest grossing seller of infinite banking policies in the United States. And he's like 12th on receiving commissions because he intentionally brings the commissions down as low as possible. And he gets a ton of referral business as a result. And so if I'm going to choose to do an infinite banking like concept for the long run, I'm going to go with somebody like that. So it's not a requirement. We have people, as people come in, I don't make any money based on any of that, but probably about 40 to 60% of our community has those infinite banking like policies. Ultimately, it's a choose your own adventure, and just understanding what the options are is the first start to growing wealth as the business.
Amazing, amazing. So another question came in. How can changes in income over time potentially influence retirement planning decisions and contribution strategies?
So in your early years, a lot of, boy, I was about to date myself. I was going to say kids thinking of 20-year-olds, but wow, I don't feel that old. But maybe I am. Uh,
No, not at all.
wow. So I would say in your early years, it's just important just to put the money in. Just contribute. Don't focus too much on how it's investing. Your biggest growth is just going to come from contributions. You're likely in lower tax brackets. Let's say you're having a successful career and you're more in the 37% tax bracket. That's where I'm going to be doing more traditional like contributions later. And as your account balance grows, so does my focus on maxing out those funds. So ideally, you're able to find something that's like a good discounted rollover opportunity. The other thing to consider is the Roth. So Roth, I do that simple. It just keeps it simple. You're not worried about taxation. So I know I'm kind of splitting between the two. And the short version is if I had to pick just one, I would only do Roth. But if I'm playing the tax game and I'm willing to invest a little bit of time and energy, I'm going to do traditional with a discounted rollover on the backside.
Amazing,
Because then
amazing.
you've got the $100,000 deduction of as you put money in, and then you're only paying taxes at $50,000. So you're coming out way further ahead.
Right, right. Amazing. How might business owners approach retirement planning differently than traditional W-2 employees?
So a business owner is in full control typically of what you're able to put into your retirement accounts. There's a big shift on whether or not you have employees. If you don't have employees, you can basically do whatever you want. There's nobody else you have to think about. The moment you have even one employee, now you've got to also have a plan for them. The IRS doesn't allow you to discriminate. There's some loopholes to jump through. Maybe you can discriminate, but not technically. You're not supposed to. And so versus a W-2 employee, there's not a whole lot you can do to save on taxes. There's a few options. One, you can contribute to your retirement plan via traditional contributions. You can do working interest in oil and gas, maybe commercial real estate. There's some loopholes. I love the short-term rental loophole where you do an Airbnb for the first 6 months, 3 months, and then it converts to a long-term rental the following year. There's a handful of other things, but there's not a whole lot you can do to shift your situation from a tax perspective as an employee. The moment you become a business owner, there's a whole list of deductions that we can now pull from. And just simple things like your telephone, your home office, occasional meals, an officer's retreat with you and your spouse because you're the two business owners. I know I do my best thinking in beautiful places. And so those kinds of things you can start stacking together and take what some might think are personal expenses and really make them legitimate business expenses. And this is one of the reasons why business owners can get so much further ahead. And then from a wealth perspective, depending on what kind of business you're in a service-based business, you're not usually growing a lot of equity in the company, but you can be more intentional about what am I doing with my earned income, and are there any assets that I can add on to it? So if I'm using an office space, can I own the office building? And that's some of the ways as we work with our families is looking at not only like what are the third party investments, but how do you maximize the stuff you already have? What makes sense from a tax and investment perspective that really can take you up a notch? And business owners have a whole lot more levers to pull from than an employee does.
Amazing, amazing. One question I saw that I'll quickly answer that came up is this webinar being recorded? Yes, it's being recorded, and it'll be available on our webinar replays page in about 2 weeks' time. So just wanted to answer that question and throw that in there. And then this is actually the last question that we have time for today. What should an investor understand about the administrative responsibilities that could come with a self-directed retirement account?
So in terms of like record keeping, I'm guessing. So if you're working with somebody like a custodian who has control, usually a lot of that is handled by the custodian. If you have your own LLC and you're investing through that, then you've got to keep up with the bookkeeping and ensure that you're keeping up with all the rules you need to do. So often people will debate between, do I want checkbook control or custodian control? Checkbook control typically means lower fees. I'm in control, but now you're also responsible for all the bookkeeping and all the costs to go along with it and ensuring you avoid a prohibited transaction. For me as an accountant, I get excited about that stuff. So I love keeping up with bookkeeping. Like doing my accounting is one of my favorite times of the month. However, not everybody is like that. And so recognizing that custodian control, where you're paying a little extra for each transaction, it's often worth it because now you don't have to keep up with all the bookkeeping, all the prohibited transactions and making an expensive mistake. And that's probably the best option for most people.
Amazing, amazing. All right. Were there any final thoughts before I open up the floor to Alberto to close us out?
I just want to say thank you all for the time today. I would love to see your faces. Tough to do over a webinar, but feel free to reach out to me at keith@financialjourney.life. I read every email, and it's not AI. I actually read it and love to connect with you.